Thank you, Raphael, for introducing the discussion. Very interesting tests and pilots undergoing at the hubs. So this panel is about AI in finance. We know AI has been dominating the news and the agenda, and we have headlines almost on a daily basis, breaking news. We have very mixed reactions, going to the extremes at times, from glorification of the potential benefits to a doomed scenario about the end of human primacy and overtaken by robots. So it's a very, very interesting debate. Today we have 4 amazing speakers with us to help us better understand the impact on the finance industry in particular. To introduce the speakers, from my right-hand side, we have Tom Matton, who's Director of FinTech at the Bank of England. Then we have Tsvetelina Penkova, MEP. We have Jonathan May with us, CEO of Lloyds Europe, and Claude Marks, Director General of the CSSF. Thank you very much for being here with us. And without further ado, as I know everyone wants to listen what you have to say, let's start with the current state of play of AI in finance, and starting with perhaps from the right-hand side, the question addressed to everyone. What is the current state of play in finance specifically? What are the use cases that you find are most in traction? Are these material to the firms and the sector overall? And where do you expect to see most of the applications of advanced generative AI models moving from pilots to actual live production? Tom, please.
So thank you for the invite to speak to you today. So 75% of UK firms are using AI. That's in a joint Bank of England FCA survey. They report that 62% of those use cases are what they deem to be low materiality from a risk and criticality to their business perspective. But interestingly, 16% of them are deemed to be high materiality. Now, obviously, they can all define that in the way they wish, but that gives you some kind of sense of the baseline. And when we've asked them about specific use cases, by and large, it's the sorts of things you would expect to see. So things like chatbots for customer services, AML, CTF, internal processes, HR, etc. But some of the sectoral differences are quite interesting. So, for example, and this is all public, by the way, you can go read it on our website. We publish all of this information. For example, we see quite a lot of use, including in quite advanced deployments in consumer credit, for example. We see less in financial market infrastructures. Banks a little bit further ahead of insurers, but not by loads. So quite interesting as you sort of break some of this apart. But overall, AI has arrived, will continue to grow. Relatively speaking, the majority of deployments are low materiality, but we can see some high materiality, and that will, again, will grow over time, I think. There's 2 trends which I do think are really interesting there, which have come out loud and clear in the survey. One is just the start of evidence of growing complexity. So some of the models that people are reporting using are probably on the more sophisticated end. And 17% of those models which were reported as being used were foundation models. So again, on the very complex end. Clearly looking for automated decision-making is something we're very interested in. Firms reported that 55% of models involved some level of automated decision-making. But actually, interestingly, only 2% of those models were fully autonomous, so no human in the loop. We'll be watching that one very closely. We repeat this survey every couple of years to give ourselves a time series. So evidence of growing complexity, nothing to worry about right now, I don't think, but something we need to keep a very close eye on. The second kind of key theme, which is something that Petra spoke about, Raphael spoke about as well, is the growing emphasis on third parties and the criticality of those third parties. In the most recent survey, 1/3 of the AI deployments used external vendors' models. And within that, we see a really quite sharp increase in concentration over the time we've done this survey, but a very sharp increase in concentration in the most recent iteration towards the top 3 providers. So we asked them to split it apart, cloud, model, and data. And you could see the concentration in the top 3 was 73% of cloud providing, 44% of model, and 33% of data, going up quite a lot. Some very clear regulatory and policy implications there. And then the very final thing I'll say is we saw a really interesting kind of dissonance that we asked firms to talk about their level of kind of comfort with AI and the technical dimensions of AI, particularly in their governing bodies. Around 40% of them said they felt they had a good grip on the technical side of artificial intelligence. Doesn't surprise me at all. I don't think it's necessarily reasonable to expect a governing body to understand all of this. The thing that's quite interesting, though, is when we asked them to rank the risks they were worried about, all of the risks they were most worried about were exogenous. So it's quite interesting. So there were things like privacy, cyber. It's quite interesting, I think, to have somebody say, I don't really understand this, but by the way, the risks I'm most worried about are things that somebody else can do to me, or environmental risks in some way. I'm not at all surprised that cyber, privacy, etc., were the sort of highest profile risks. But that sort of dissonance is an interesting one, I think. So I'll stop there.
Thank you, Tom.
Perfect. So I will disturb the chain now and give a bit of a regulatory perspective here. So I think we all know the benefits and the opportunities that the AI offers us. We've been speaking about this since the morning, more or less, in all the interventions so far. And AI is being already implemented in a lot of areas and aspects of the way the industry functions, and especially the financial sector. So if you allow me, I will just very briefly focus on some of the challenges that remain, because further on in the discussion, I would like to build upon the reasoning why we are still focusing on making a strong regulatory framework to ensure a level playing field, which is fair for financial services, for the consumers, and for the industry of the EU. So I will focus on 5 areas which we still find challenging, or like we still find that contain certain amount of risk when we're speaking about the implementation of AI in the financial service sector. So the first one is data security and privacy. This would remain our core priority when we're building the whole regulatory framework, when we are focusing, as we do now, on the AI Act implementation, because AI would rely... You hear me well, right? Perfect. Yes. AI will rely on large amounts of very sensitive data, and our responsibility is to make sure that this data is safeguarded. Because when we speak about private data, we know how a breach of this can actually destroy the trust in the whole system, which basically leads me to the second challenge. This is consumer trust. We speak a lot about AI applications in all areas of our life at the moment. But allow me to have this judgment that when we have the financial service sector, there is a higher standard expectation for the consumers when we speak about the trust level there. So they need to have faith in the financial institutions and the instruments that have been used. And here it's another aspect also which applies to this part. This is the literacy. We are facing the challenge sometimes that the financial literacy is not at the high level as we want it from the European customers' perspective. And that's why when we're speaking about customer trust in the new technologies and AI application in the financial sector, we have to be aware that the standard and the expectation from the receiver side is much higher than any other area where we see the application of AI. Third is, of course, transparency and accountability. You see that they're all going in a chain and they're more or less connected. But there must be like a very well communicated and well explained algorithms used by the financial institutions, which ensure that there is transparent and accountable way of tracking the data usage and the results that have been generated by AI technologies, the aspects and fields in the financial sector. And the last two, I will be very brief. Fairness. What we see when we look at different data and studies is like the monitoring for any discriminatory practices and patterns when we're speaking about AI application is starting to be quite important also from the regulatory perspective, because we want to make sure that this is avoided. And last but not least, we have to acknowledge the human factor as well, because AI is here to supplement rather than replace completely the human expertise, especially when we're speaking about judgment, experience, and giving a proper financial advice to both retail customers and, of course, the professional investors. So we need to make that differentiation and ensure that we are working towards striking the right balance into that mix. I will stop here now, and I'm sure we're going to touch upon some of the topics further on.
Exactly, we will come back to this. So data privacy, consumer trust, including literacy, transparency and accountability, and fairness, and keeping the human in the loop, if I can summarize your intervention. Now, going to Jonathan, going back to the state of play from the industry standpoint, could you give us your view for the insurance sector over and above what Petra introduced in the introductory remarks? And also would be very interesting to hear from you your perspective on this potential risk of dependence on a small number of third-party providers for AI-related services that Tom mentioned.
Sure, thank you. So yes, as Petra mentioned, it's still quite early stages, the level of AI use within the industry. I think reference was made to the sort of back office functions, if you like, improving the efficiency, improving the claims handling experience for the consumer, and also compliance as well, checking, because it is a heavily regulated industry. There's lots of compliance checks that we need to do. So using it there is definitely coming through. But even there, I think, I echo the points. We need to be very mindful that this is to the benefit of the consumer. So is it improving the experience to the consumer, the use of AI in the back office, in the claims experience? So if you've just lost your house to a natural disaster, do you want to speak to a bot, or do you want to speak to a human being? So I think we always have to have the value and the experience for the consumer at the front of mind. We are also seeing, again, new risks coming out, excuse me, for which we need to provide solutions for as an industry. So whether that is sort of AI models themselves and providing insurance for the providers of those models, etc., or other things such as self-drive cars and things like that. So the technology itself is then creating new, a demand for new products from the industry. On the front office, as it was said earlier, this is still very, very early stages. What we are seeing is algorithmic underwriting, where you've got, say, a lead underwriter is a decision, and you've got sort of follow capacity decided on a algorithmic basis to more quickly get that capacity in place to meet the demands of the customer. I think it's fair to say that in different parts of the sector, the use of AI is greater. So Lloyd's is predominantly wholesale insurance market, where we're bringing different parts of the ecosystem, the policyholders, the brokers, the carriers together, and we act a little bit like a quasi-regulator. So we're doing largely wholesale insurance. In insurance like motor, obviously AI is probably much more advanced, the high volume classes of business. But we can see the potential for augmented underwriting. So a lot of the tasks that an underwriter has to do, we can use AI to augment their underwriting, so that the underwriter is focusing on where you need that human decision on the complex risks, and is then supported by the technology to enable them to make those judgment calls, which should make products for existing risks, much more accessible as well.
Thank you. Claude, moving on to you, it would be interesting to also hear from you how you address the current data gap in terms of the deployment of AI in finance. We have a lot of evidence that is, in a sense, anecdotal in many jurisdictions. The data gap in this area is one of the policy priorities also at the G20 level, with a deliverable coming to the South African presidency later this year. How do you see this issue of data gap, and also what's your experience with the deployment in Luxembourg?
Yes, good morning, and thanks for having me here. In terms of the, let me start with the last bit of your question. So what's the experience in the Luxembourg Finance Center? We have just surveyed some 500 financial services providers, which is a very large group of people that we supervise, and more than 80% of people surveyed have participated in the survey. And what we have seen is echoing actually what has already been said by Bruce and others this morning, is that we are seeing slow adoption. You know, currently only 28% of people surveyed have actually in production or are testing, you know, AI systems, and 22% want to do so in the next 12 months. So that gets us to 50%, which is significantly lower from the experience that Tom has at the Bank of England. But I think it's largely reflecting what we see in continental Europe if you look across all the industries, so be it asset managers, be it banks, be it fund managers. And then, you know, in terms of what is being used, it's largely back office efficiency type of use cases that we see, and very low percentage in products and client-facing systems. But it's true that we are really facing a data gap here. There are many generalist surveys out there by Big Four and other consultants that give a very high-level oversight of what is being used, but we are lacking data on the effectiveness of systems being used, on the risks that these systems generate, and the risk mitigation measures put in place by financial service providers. We are also lacking data on the long-term impact, and so we have a regulatory blind spot here. And that means that you know, it is very difficult to have evidence-based policy decisions at this point in time. Now, what we could do to close this data gap, I think we could have standardized AI reporting and transparency from the market. For instance, what the number of AI systems are used, the type of systems being used, the data sources, key performance metrics, and so on. We should also have independent research and public data repositories where we overcome the confidentiality issues in that anonymized data is being populated, is populating these repositories. And then we need cross-sector collaboration and data sharing amongst regulators, market, academia, and tech firms. I think these are a few things that we should be focusing on in a collaborative effort to help us to overcome that data gap.
Thanks, Claude. That's very, very interesting indeed. So going back to regulation and back to Tsvetelina, you've given us a little bit of an overview of the risk and the risk mitigation when it comes to the use of AI in finance. Now, looking more at the bright side of the story, what is the expected impact of the AI Act on the European financial sector more broadly from a positive standpoint? How can AI, for example, help integration of the EU single market? Can it also help with the Capital Markets Union project? What is your view on that?
I also try to present some opportunities together with the challenges, trying to justify what we do in the regulatory framework. Because I mean, we have to be very fair and honest about the possible risks and the problems we might be facing. That's the only way to actually create a stable framework from that perspective. So a very important question, like the Capital Markets Union and like the whole functioning in the financial sector in the EU, is one of the key topics currently all over Europe in light with the competitiveness aspects, which was discussed from the first talk this morning already. It was one of the key topics. So definitely the Capital Markets Union is one of our priorities and finally making it work. So AI is definitely a part of it, and I would just actually focus here on 3 key points which would help us build that Capital Market Union working, because the first problem is the fact that we don't have harmonized financial services and a regulatory framework across the EU. That's the real and the pragmatic reason for the postponement of creating the well-functioning Capital Markets Union. And AI could actually be very helpful in trying to make sure that we find the smoother cross-border cooperation, and especially ensure that the regulatory framework could be harmonized in the most efficient way. So the biggest challenge and the most obvious application in AI is in that aspect. Of course, step 2 is to make sure that the institutional investors and the professional investors, they see the value added in the cross-border transactions and actually try to shift a bit the level of risk averseness, because that's one of the biggest challenges when we're speaking about the functioning capital markets in the EU. And last but not least is the smooth liquidity and capital allocation, where AI also plays a key role. So first, regulatory harmonization. Second, the professional and institutional investors should actually start moving capital and investing it in a more efficient way within the EU. And last but not least, once all that is ensured, the capital allocation would boost all the participants in the financial sector to be part of this. So there are many more things to say here, but I think those are the 3 quite obvious steps and a very visible role of the AI in that field.
Jonathan, Svetlana touched on competitiveness and the potential impact the AI Act is having on the competitiveness of the European financial sector. How do you see from the industry standpoint the consequences of this regulation for competitiveness? Also taking into account particularly pertinent the potential controls for general purpose systems such as LLMs and other generative AI models.
Sure, thank you. So I think we all agree we want to stay competitive and we want to be innovative, and the importance of having regulation that is pro-innovative, if you like. But obviously, I think one of the ways that the EU AI Act can help with the innovation is that it does provide regulatory clarity. And I think particularly for financial services, that having ambiguity is in no one's interest. It's not in my sector's interest, because the risk of things going wrong can be quite large, and therefore what you want to avoid is sort of people just doing a wait and see happens, sort of stagnant. So having that clarity is beneficial, definitely. And obviously this is one of the first pieces of legislation out on AI globally. So I think that's to be welcomed. But as I said, it's important that we do remain competitive. We also have to recognise that this is a rapidly evolving area, you know, and the risks in this area are evolving. So we need to keep that dialogue going, and we also need to, you know, between supervisors who are perfectly placed to see the opportunities and the challenges across the different layers within the financial services ecosystem and support and coordinate. But you need to have those sort of grown-up conversations. This is what we're seeing. This is the risks that we're seeing. This is how it's changing how we want to operate, and having those conversations, sharing the data, sharing the information, I think is absolutely crucial, because the risks will emerge, maybe the wrong word, but greater awareness of the risk as the technology gets more and more developed, I think is key. So I think this is great. The Act is great because it removes a lot of the ambiguity that was creating the sort of paralysis, if you like, and now you've got that certainty. So it does help AI service providers, etc.
A lot of the discussions this morning were touching on data, whether it was FIDA or Raphael's discussion about specific use cases and pilots. So I'd like to hear from Svetlana your view about the interplay between the AI Act and other EU regulation, such as the Data Act, but also GDPR or even the Data Governance Act.
So the short answer is the AI Act is in harmony with everything else that we have set in terms of regulations, all of the ones you've listed. But please allow me to explain also the infrastructure we're trying to build with all those legislations. I know it's still the first panel in the morning, but recall back some of the challenges I've presented, and now I'm going to try to explain how are those resolved with the legislative infrastructure we are trying to create. Actually, we have created, and now it's about time to see how the implementation will go. So if we combine the GDPR with the AI Act, then we get the answer to the privacy and the security of the personal data. So making those two work together would resolve one of those challenges. And when I say resolve, we're not speaking about like some magic solution which ceases the problem to exist in the future, but it is offering the ways to solve it for the time being and for the long term, of course. Data Act plus the AI Act, it is all about the quality of data. So basically, it's ensuring also some of the ethical standard, but it's about the quality, ensuring the quality of data, and again, safeguarding it. You've asked also about the Governance Act. So if we combine that with the AI Act, again, we're speaking about sharing of data in line with all of our high standards. So we have the privacy, you have the quality, and now you have to share it because it has an economic value, and that's the only way to make it actually work. And last but not least, you've mentioned FIDA. If we combine it with the AI Act, it touches upon one of the last challenges which I've outlined before. It's about the fairness standards, especially in the high-risk areas. So this is a map which basically shows that understanding all the challenges, we've tried to create an infrastructure which gives us the tools to be able to overcome, resolve, or address them in a timely manner. But it was already touched upon that by all the speakers around me, actually, and by the previous interventions as well, that we need regulatory clarity and predictability. But now it's also the time when we have to offer some flexibility, given that the technological advancement is very quick, and if we want to actually speak about true competitiveness, we have to be able to look around us and see what's happening. So I'm very confident that we have created the right framework and infrastructure. Now it's about time to implement it, but with a very common sense of having the flexibility which makes it work, given the fast, rapid investing technologies.
Since we're good with time, I'd like to tease Tom with the question of competitiveness that keeps coming up. From your standpoint in the UK, we are reading everything about the explicit criticism to the EU about the over-regulation potentially hindering innovation and not allowing the beneficial aspects to come up. We also understand that regulatory clarity and risk awareness, as Jonathan mentioned, and this reduced uncertainty helps promote innovation. How do you see all that and from the competitiveness angle from where you sit in the UK?
So maybe to completely dodge your question and ignore the competitiveness part of it, let's think about growth rather than competitiveness maybe. So look, we want growth, we want innovation, we want to unlock the productivity puzzle. We have a bunch of, and it's not just in the UK, this is probably true across much of the sort of the Western world. We also have a bunch of structural challenges which, you know, do lean on growth, aging population, etc. So that we need to use AI across our economies is you know, kind of totally uncontroversial. It will only be sustainable though if this is used safely. And the question is, how do you give people that right balance between users, potential subjects of AI processing, knowing that this has been safe, done in a manner that accords with their societal norms and their expectations, but also isn't the wrong fit for something which the rate of progress here is measured in days at the moment, right? So it's not a natural fit for very detailed regulation. I think when we apply this in the UK context and in financial services, the first thing I say is obviously, you know, we contribute to broader UK government efforts, and the UK government has collaborated with colleagues around the world, including the European Union. So we contribute to broader UK government efforts. Obviously, that is focused on the most high-risk deployments. Financial services isn't currently one of those in the view of the UK government. When we drop that down then into finance, where we work very closely with the Financial Conduct Authority, we jointly had an artificial intelligence public-private forum. We asked them to write a report for us on barriers to deployment and use of AI. We published that report. They didn't really identify regulation. They basically said regulation wasn't a barrier. That really poses a bit of a puzzle because it's very clear where they see the limitations. It's access to compute, access to skills, access to data. It's these big sort of infrastructure and structural questions. They would like some more regulatory clarity at the edge. The areas they identified for regulatory clarity were a bit more guidance around expectations of senior management and those in governance functions, and a little bit more around things like model risk management policies. Realistically, providing more guidance on those, which is something we're very, you know, kind of willing to do, probably isn't going to resolve, though, this slightly more fundamental point that quite a lot of firms say to us, look, there isn't a specific regulatory barrier. There's not a thing where we say, if you just change that rule, this would be much better. The thing they're worried about is this broader question about uncertainty. And when something is moving so quickly, when what you're dealing with, I think particularly in the consumer space, starts to touch on social norms, your social values, broad concepts like privacy, which sort of transcend finance, you get into the sort of dynamics that Petra was talking about, right? And there you may find that regulatory certainty is fleeting because society is moving around these technological developments. So I think there is a big question there about how can we best make sure that we're not stifling the innovation, we're staying on top of the progress, we're acting early where we see actionable risks, but also, you know, not too early. And I think for us, we're very, you know, happy to issue guidance. But really the starting point for us, I think, in the UK is to deepen the conversation, much in the way that Bruce talked about this morning. So we've launched an artificial intelligence consortium for academics, for technology experts, for industry to come and have a conversation with us and the Financial Conduct Authority about use of AI in financial services, and for us to really start to try and get into some of the knotty technical issues. So, for example, how do we think about things like algorithmic collusion? How do we think about shared methodologies which may be hidden in models and which lead to procyclicality and herding? And I think we've got to be humble as well about what this will involve. So in the financial stability domain, which is kind of, you know, where I work, we're very used to following objective, largely sort of output type measures, asset prices, economic variables. We don't look at kind of shared assumptions going into models. That's not something we generally do. I mean, probably the closest we get is approval of internal capital models. that's light years away from dynamic, constantly evolving models like artificial intelligence. So I think, starting to deepen this conversation and think about how we can be agile is going to be really key to unlocking the potential here.
Thanks, Tom. You mentioned that based on your survey results, that regulation does not seem to be one of the major impediments to the wider use of AI in finance. So I'd like to turn to Jonathan and also Claude for their views on that.
Sorry, could you repeat?
Yes, so one of the findings that Tom mentioned was that regulation does not seem to be an impediment to the wider use of AI by the financial sector. Is this a view that you share from your day-to-day?
So to date, no, but the regulation is obviously just coming out, really, in a lot of jurisdictions. So obviously, we talked earlier about the EU AI Act, which does give the certainty. But equally, I do think there has been a degree of wait and see to see what happens with some of the regulations. And therefore, that's maybe impacted to what extent AI can be utilized as well. So I don't think it has been to date. Obviously, as the regulation evolves, it's important that everyone's sharing information about the risks and having that open dialogue, so you continue to get, because you need the right regulation in place to manage the risks. Whether that's various different risks that exist, and that it is proportionate, while still creating that sort of pro-innovative, competitive environment that we want. But you have to have the right regulation and proportion.
Yes, I think that the AI Act is not harming deployment of AI, and it's a generalist regulation that classifies essentially AI systems into 4 risk categories. There's no system that is forbidden in the European Union under this AI Act that would negatively impact finance here. We have a couple of high-risk systems when it comes to credit scoring, or in insurance, indeed, we have a couple of applications that would be considered high risk, but that's very manageable. And then, we have various sorts of regulations that were already touched upon that also have an impact on the deployment of AI. We have market manipulation regulation, we have mis-selling, we have cybersecurity, DORA, data protection, privacy. Probably the GDPR and data protection regulation had the biggest impact on deployment of certain AI systems, especially when it comes to using widely used US-based generalist generative AI systems like ChatGPT or Gemini or Copilot. But there are solutions that have been deployed by the vendors to overcome those data protection and privacy issues through local versions of those systems, through air-gapped servers, sovereign cloud systems, and the like, where all these systems are made available, but in EU servers, not to fall foul of privacy and data protection regulations. So, in summary, I think that the current state of play is that the various pieces of regulation that impact AI did not have a harmful impact on the deployment of AI.
So Jonathan mentioned that this is an ongoing process. So the next part of our discussion is about looking forward. And I would like to follow up, Claude, on what you just said. Going forward, do you think there will be a need to refine the rules? Do you expect any gaps to be identified and any further rules to be needed? And to note also that we have run OECD analysis late last year on the regulation of AI in finance in the 38 member countries of the OECD. And the result was that the vast majority of jurisdictions in OECD membership, which goes from US, Canada to Korea, Japan, there is appropriate regulation in place. Depending on the jurisdiction, it's a mix of old rules, new rules, binding, non-binding, finance-specific, cross-sectorial, given the technology-neutral approach, but also that there may be a need to continue to monitor, given the rapid developments in this area, to identify and address any gaps. So what's your view and expectation on that front?
I think it has been said, this is a fast evolving matter, and we are still lacking proper data on risks and risk mitigation measures that are being put in place. So I think we should not assume that financial market participants do not properly mitigate risks associated with AI. Now, we have specific risks in AI that are not covered right now by the current rules. You know, explainability, AI-driven market distortions. We have this risk of the black box, of the lack of accountability, transparency. We have the risk of reinforcing biases, and we have the risk of flawed algorithmic trading and model drift. So we do have specific risks of the use of AI in finance that are not currently being addressed. Probably the largest one is the one that Gary Gensler flagged, you know, on the herding risk and the reliance on a few data models that Tom also mentioned earlier on, that could potentially lead to a financial stability risk. My view is that, you know, first, we are not fully equipped at this point in time to make a call whether or not we need specific regulation for AI in finance, in addition and over and above to the AI Act. And second, from a competitiveness point of view, if we came to the conclusion that we need something else, it should be at international level and not at EU level. Because let's face it, all systems widely used today are US systems. They are the generalist systems, the generative AI systems that I mentioned. They are the Bloomberg GPT, they are the Bond GPTs. They are all American systems, and tomorrow there will be American, Indian, Chinese systems. So if we wanted to have bespoke AI for finance regulation in Europe, the risk would be to build Fortress Europe and to prevent financial market participants from properly using the systems that are being deployed outside of the European Union. So what we then would need is international regulation sponsored by the FSB, sponsored by IOSCO, you know, and like one good example of how we could go about this was the Bletchley Declaration in November 23 in the UK, where the European Union plus 28 other countries came together and looked at the risks of AI, also AI in finance, and you know, we're thinking about what framework do we need, and this comprised China, this had the United States, this had the UK, and I think that would be the way to go.
On the supervisory front, Tom, do you think that there is perhaps a need for more supervisory guidance to help companies in their compliance going forward?
We're certainly open to it, yeah. But I think we'd need to, and this is the point of the consortium, we'd need to understand exactly where it's needed. Just issuing a load of guidance and imagining it's going to make everything clear is not, you know, necessarily the way forward. We've heard some specific stuff around senior managers' responsibilities, around model risk management policies. We'll offer some clarifications there. And I think for me, one of the big things to think about actually here is how we can use artificial intelligence to lighten the compliance burden and improve the risk management and compliance operations, both of firms, but also of the institutions. I mean, Petra raised the interesting question about using artificial intelligence to respond to consultation papers. We've actually done that in the UK. The digital pound consultation had 50,000 responses. No way we can read 50,000 responses. We used some computational techniques to review that. We've published all of our approach to that. It was legally novel, so we had to go and get legal opinion on this. And actually, it was exactly what Petra expected, which was we could see all of the templates, the letter writing campaigns, and you could see it very, very objectively. You could see it visually, and actually it allowed us to process without human bias, with proper attention, all of those responses, because if not, 50,000 responses would have been unmanageable. So I think the more we can use these sorts of techniques and look to the positive, and the positive in that case was the fact that we managed to review all of those responses. We did it consistently, we did it without human bias, and then we had mechanisms for diving into the ones which were more distinctive. So yeah, we're up for guidance, but I think we should also be thinking about how we use artificial intelligence ourselves.
So the example you're using touches also upon skills and capacity. And I'd like to ask both Claude and Jonathan a very quick reaction on that front, on the skills and capacity, both for the supervisors and the institutions, as well as the industry.
So, I mean, I mentioned it earlier, I think the supervisors are uniquely placed to look at the risk across the different layers of the ecosystem and have that open. I mean, it's difficult. Don't get me wrong. It's a real challenge for supervisors to do that. And I think everyone appreciates that, particularly as this is evolving so quickly. But they are uniquely placed to be able to do that. So it's a key role as this area evolves. But they can only do that if everyone is talking to each other. If you're maintaining that open dialogue. If it becomes a very one-sided review or discussion, that's not going to help anyone, in my view.
Yeah, I think that supervisors are, of course, constrained in terms of, technical skills, resources, and budget. And I think all regulators in the world face budget constraints, and so we have to be nimble here. On the positive side, though, I think that, I've seen, at least in my jurisdiction, we've equipped ourselves with AI expertise, with skills, with data scientists, and also we've equipped ourselves with systems that function in an air-gapped, secure environment. And so a number of my fellow colleagues in other jurisdictions are doing the same. I think at the same time we have cooperation initiatives that are very good. So we exchange at European level in the framework of the EBA, in the framework of ESMA, IOPA. We do exchange knowledge on who is doing what. We can pick ideas from others. There are also subtech tools that are developed together, for instance, at the level of the European Central Bank. A number of subtech tools have been developed that are deployed amongst all the member states. We have the BIS initiatives that are useful for all of us. And so I think cross-border collaboration and exchange of knowledge are going to be key also to overcome the challenges that we face in terms of resources.
So we've had a very rich discussion. So to help our audience have some key takeaways, I want one 30-second key takeaway from each of you, starting with Tom, please.
These technologies are global. They don't really recognize borders in the way that conventional financial services regulation does. So how international cooperation is going to work, thinking about things like Bletchley, Paris Summit coming up, but then also the work of the international organizations, OECD, Financial Stability Board, etc. That's the really key thing for me, much as Claude mentioned.
Digital literacy and financial literacy must be our key priorities. If we are having an honest and true conversation about competitiveness, we should all know at the end of the day, it's all about scale.
I mean, for me, I think it's just collaborating to make sure we get the right regulation to manage the risk, whilst continuing to support innovation and competition as well.
On the market side, I would say collaboration is key. I would also add a word on the corporate side. We are missing talent at board level right now, and we are missing talent at the C-suite, senior executive level, and I think those are going to be key going forward.
Thank you, everyone. It was a fascinating discussion, and please welcome me. Please, let's thank all our speakers.